Back in October 2020, I talked about FSLY stock and the exciting industry of edge computing. Well, during that time, the stock was trading around 74, but I did say that I thought it was trading at a pretty decent premium, even though it was trading at 140 previously.
That is a high growth rate, but at a 33.7 price to sales ratio, it doesn't look that great.
So after today's earnings, it crashed and it hasn't been getting a lot of love. So I wanted to talk in this video about the earnings and my overall opinion on the stock as of right now. The stock is trading closer to 41, but this morning it was down pretty bad, around $34. So there was a very negative sentiment around the stock this morning, and it's bounced back a decent amount. But let's talk about the overall earnings. When I initially looked at the Q2 results, it didn't look that bad. I mean, it pretty much hit consensus of a loss of 15 cents versus expected 17 cents, so better on earnings per share. And the revenue pretty much came in line, around 85.1 million versus 85.73 expected. You can't really complain about those numbers too much, but what caused the downward spiral in the price was definitely the guidance and kind of the sentiment around the outage that happened in June. If you don't remember, on June 9th, there was a global outage for their content delivery network, and within about 49 minutes, 95% of the network was up and running, but every minute counts when you're running a mega website, such as websites like Reddit, New York Times, Amazon, and even eBay. So these are obviously some big players, and for every down minute that these companies are facing, they're losing business. So obviously FSLY, most important thing for them is to keep their network up and keep sites running. And this outage was bad enough to actually have one of their top 10 customers not return back to the platform yet. So the CEO addresses the issue and how that outage could affect their image with upcoming customers and even their current customers, and really reduce the confidence in their overall platform. That's definitely not something you want to hear as a shareholder, because that image deteriorating means that less revenue is going to be coming in. Now, it's not game over, right? But we see in the outlook them talking about this revenue effect. So full year total revenue is now expected to be 340 to 350 million instead of, I think it was around 380 before. So they reduced their outlook and overall increased their net loss per share. So not great numbers to see when it comes to guidance, and that's what's really causing the stock to crash this morning and after hours yesterday. Now, one of the positives with this stock getting absolutely wrecked lately is that the price to sales ratio on this thing has come way down. We're talking about 16 versus in the 30s, last year. So compared to a lot of other companies, the price to sales ratio and the multiple is coming more in line to something that's reasonable for a SaaS company, something around 12 or 10. And that's much different than a lot of companies that are currently out there. Whereas if we look at a company like Cloudflare, it's currently trading at a price to sales ratio of 75.63. That's pretty high, especially for the expected revenue growth for Cloudflare is higher, but the question is, does it deserve such a high premium versus a company like FSLY, where the 5-year growth rate for revenue for Cloudflare is around 37.8 and FSLY is around 25.7. One thing to note though is Cloudflare does have a higher gross margin, so all things equal, they should probably have a slightly higher sales to price ratio. But when we look at the historical price to sales ratio by sector and scroll down to software, we'll see that it's normally around 12. So what's good about FSLY now is that the multiple has come down. The likelihood of the stock going down 50% from here is much less likely than when the price to sales ratio was inflated. I think FSLY goes to show that when it was trading in the 30s for a price to sales ratio, as soon as there's negative sentiment around revenue growth slowdown or a miss, or their image is bad for a moment or a quarter, 2 quarters, that's when the stock can fall 60, 70%. And the same exact thing could happen to Cloudflare if they have a screw up. Now with FSLY, right now they're beaten down and everyone is hating on them. So this is when it becomes, do you believe FSLY will bounce back? And that is the ultimate question. Will their revenue growth continue, and will they recover from this? Now, it's not all bad news in the earnings report. One thing that I did like to see is that their customer count continues to grow. So it's currently at 2,581 versus 2,458. And it is important to continue to grow their customer base and make sure that they're expanding and not concentrated in those big customers. So companies like TikTok, if there's fears around, TikTok leaving, all of a sudden they lose a huge part of revenue. If they can spread it out across a bunch of different customers, well, if one decides to leave, then it doesn't impact them as much. But to be honest, I didn't love the earnings. There isn't too many positives in my opinion. One thing that also sucks is that the gross margin went down, excluding one-time items, which isn't great to see. I like to see expanding margins. So obviously, revenue is up, but not as much as people really want. Customers is expanding, which is good, but the overall gross margin is down. But what is nice is that in the short term, this negative sentiment does bring down the multiples. For me, if I could scoop up a little bit more at a price to sales ratio of 12, I don't think this company is going away, but something like a 12 price to sales ratio with their outlook of 350 million, that's a 4.2 billion valuation, fair value, around the end of 2021. It's currently trading at 4.82. Now, it was probably closer to that valuation this morning. I just wasn't quick enough to grab more shares, but honestly, I do want to see a quarter or maybe 2 quarters where they're kind of steering the ship in the right direction. I don't love to see the sentiment down, the margins down, and the revenue projections lowered. I would like to see kind of an upbeat outlook. Now, of course, that's not where you can make the money. Now, some people may say, shouldn't you be adding when other people are fearful? My concern is that this isn't a one-off situation. They keep on missing on their earnings. They keep on lowering guidance, so the revenue growth isn't as high, and their image is kind of under attack right now. So I think they need a couple quarters or even 1 quarter where they kind of shake this off and say, hey, listen, we're turning things around. We're adding more customers. Our margins are increasing. I just want to see a little bit more positive news in the earnings reports before jumping in with a bigger position. Right now, I only have 3 shares, right? I never took a huge position in this company. Something like if it falls into the 20s, that's where, okay, you buy when other people are fearful. I think it's a good bargain. But yeah, that's kind of where I'm at with it. If you guys did enjoy the video, make sure to hit that like button and consider subscribing to Main Street Wolf, where we talk investing, stocks, options, anything to do with money. Thanks guys for watching and have a great day.